Hello, this is Howie, and I'm here to help you win with money. I am a money coach, and today I'm going to do a new Exposed by Math. This one is going to be big because what I'm teaching is still very controversial. How can it work? How can you get another loan and still be cheaper than the original? Robbing Peter to pay Paul? None of this makes sense. Another one is, can you really pay off your loan in 5 to 7 years? That's what Velocity Banking claims. Is it possible to pay 18% interest on a loan and still be better off than a 4% mortgage? Have we been lied to all these years by the mortgage industry? Your interest is low. It's a small percentage. In today's environment, some of us have 2% interest, 3% interest, 4% interest rate on our mortgage. Have we been lied to for all these years? Stay tuned for this episode, and I will answer this by exposing it by math. This is going to be a long video. You may need to watch this multiple times. And some of it is complicated. If you don't understand the math, that's okay. Watch it over and over. I try to model different scenarios so that you can see how this works in various scenarios under different conditions. Too many people try to sell you a program, enroll you in their coaching, or sell you a masterclass. Can you actually understand this by watching a YouTube video? Well, that's my goal. I want you to watch my video and let me try to prove to you either one way or another whether or not this concept makes sense. My goal is to use Excel. I believe Excel, you can model any business rule as a formula, or if you use some programming to explain how it works. So that's my goal in these videos. I want to try to get rid of myths and bad teaching, a lot of deceptive teachers out there, or people just trying to sell you something because they want to make more money off of you. I'm here to help you win with money. Let's do this together. Let's do this $1 at a time. If you like my video at the end, please hit the thumbs up. Subscribe to my YouTube video channel. I do many of these exposed by math. So let's get started. Here is how I'm going to start. I did a video for those who don't understand how mortgages work or refinancing work. You can watch that. Is it really necessary? It's not, but I would like you to just understand how mortgage loans are calculated. And that's an easy video. This one's a little bit harder. So what is Velocity Banking? Here's a quick Google search of Velocity Banking. Look, a lot of topics on it. The truth about Velocity Banking. Paying off your mortgage faster. It doesn't work. Here's another one. Can you pay off your mortgage in 5 to 7 years? How about this one? Can you use your credit card to pay it off? What's missing? So look, there's a lot of people talking about Velocity Banking. So how does this really work? The concept requires a loan that interest is computed based on the outstanding balance that you have, and that is still cheaper than a loan that all the interest payment is computed in advance and front loaded. What that normally means is an installment type loan. And the most popular that people think about is a mortgage, where the loan is computed over a 30-year time frame or a 20-year or even a 15-year. So the interest is front loaded. Whereas a HELOC, or something where you borrow from a line of credit, the interest rates are computed slightly different. It is not a fixed loan payment, the terms, because if you pay it down quick, they use something called the average daily balance. And so, is this possible then where you're getting a loan, one loan, where the interest rate is computed slightly different to pay down another loan where the interest rate is computed over a fixed time frame and it knows how much you're going to pay in interest. And that's really the high level concept. Does it require good credit? It may. It doesn't always have to. But if you're going to get a loan through a bank or through a equity in your home, it may require a combination of having home equity and good credit. If you're borrowing from your cousin who's giving you cash, you may not need any credit. You can be a deadbeat. But it does require a place for you to get the money. And some people even use credit cards. The next thing, it does require you to be cash flow positive. And that's just common sense, guys. Let's just stop here and think about that. When people say, oh, well, these things don't work or that don't work or whatever it may be. If you're negative cash flow every month, that doesn't work. You are getting broke every month, or you're getting more negative every month. And so this concept of you should have a positive cash flow. You can be in positive cash flow and still be in debt $100,000 or $200,000 or even more. There are people with $1 million in debt. Your home may be $500,000 or $600,000 in debt. You may have a couple cars. You may have some other credit card debts, student loans. But if you make a decent income and at the end of the month, you still have an extra $1,000, $2,000 surplus, even after you service your debt, it is possible. So positive cash flow is required. And I'm going to use different models. I'm going to use a traditional mortgage using 30 years. But it will work if you still have 28 years left or 25 years left on your mortgage. What I will not cover today is student loans. Student loans are generally anywhere from 5 to 20 years, depending on how much balance you owe. Auto loans are anywhere from 36 months to maybe 84 months. So I'm not going to cover those because there is less bang for the buck on a shorter loan. But a mortgage is generally the most popular debt to pay off using velocity banking. For this model, I'm going to use something really dumb. I'm going to use the credit card. I'm going to use a horrible assumption. You were using 18%, but there are many people who can get 0% loans from credit cards. You can go to the bank and borrow at 9%, maybe a personal loan or a business loan. And then we're going to model it against this concept of, hey, but haven't this concept been around forever? Paying extra payments just from your cash flow alone. So we're going to model those out and see what happens. At the very end of the video, we'll summarize it, and then you can leave your comments below. But before you get angry, remember, I'm not here to tell you what's good or bad. I'm just here to show you the math. I'm a big fan of you use what tool works for you, and if it doesn't work, that's okay. If you're not in the situation to take advantage of it, you shouldn't. If you don't have positive cash flow, you shouldn't do anything like this either. All right, this is my favorite part. Exposed by math using Excel. First thing I did, I created a spreadsheet. For our example, we're going to use a credit card. We're going to use a really high interest rate. Let's use 18%. What does this do? There is some daily interest rate, and I'm going to show you what this means. On the internet, one of the most popular numbers people use to do velocity banking or even infinite banking, which is not covered today, but they use a very similar concept. It's this $1,000 extra a month to do velocity banking. So I like to use, let's try to figure out what free cash flow you would need. So if you had $1,000 extra every month, I modeled it out. It's saying you can do a chunk. And I use a factor in here, a safety factor, right? 95% of the value gives you a 5% cushion in your budget, okay? Is that right or wrong? I don't know. Depending on how well you run your finances, some people may need a bigger cushion for emergencies. For other people, if you already have emergency fund, you already have cash to fix the roof or fix a blown engine in your car. So those are different issues, and we're not going to cover emergency funding and having extra money aside. But with that said, I factor in a safety, right? If you only have $1,000 free cash flow, I'm not going to tell you to do a $12,000 chunk, which is very popular in the internet. But you see, if that's truly your cash flow and you're chunking this, you may not have money to pay down other debts. Because let me just explain what this is. You plug in the interest rate, it knows how to compute it using some formulas, how much you borrow, how long it takes to pay down. The way chunking work is they want you to pay it down in 12 payments so that you can repeat it all over again next year, right? It's the same month. I want to reborrow another $12,000 over here next year. It's how they want you to do this. Okay, so for modeling purposes, you see that having $1,000 free cash flow, they want you to chunk $12,000. But in reality, that doesn't make sense. You really do need, right? You need a little bit more cash flow. So here, it doesn't really matter what it is. So I use this concept of, okay, if you have a free cash flow, I use a suggested chunk. It's always smaller and a little bit more conservative. So that's the first thing. And to prove that this works, if you hit 0, you see that? Your monthly payments are nice and pretty. Boom. So you know this works. If you can borrow money for $12,000, and your interest rate is 0, it's $1,000 payments, which makes sense. But if you have I don't know, let's say you borrowed it for 7%. You see, the suggested payment goes up. Your total interest that you borrow goes up. The monthly payments are higher. And these are total payments. So in this example, I told you I would like to use 18%. And one thing you're going to notice is if you chunk 12,000, the internet uses payments of only 1,000 per month. And I'm going to come back to that in a little bit. So let me explain how this works. So we're going to go to a mortgage calculator now. Okay? And here's one already. So the first thing we're going to do is let's model this out. We're going to need a scenario where somebody bought a house. Now, in our first scenario, because we're using $12,000 chunks, I'm going to assume this family is a little bit more upper middle class. So we're going to use a $500,000 loan. And we're going to just assume it's a 5% interest rate. So the first thing you notice is this is how mortgages work. Your payment on your mortgage would be $2,684. You see how little is going to principal and how much is going to interest? And in the first year, you can do the math real quick. The first year, $24,000 went to interest. And only $7,000 went to principal. Okay? So that's the first thing you're going to notice. Total interest rate. What I want to do is record this as your baseline. So you got that? If you did nothing, if you're in this scenario today, you got a $500,000 loan, you got a 5% interest rate, you're going to pay $466,000 in interest, and that's your typical mortgage payment. Okay, so what does chunking mean? What that means is you're going to borrow money from a credit card, in our example, pay 18%, and then I'm going to have some monthly payments, because the goal is you want to pay this down. But with this $12,000, and these are the days where it was so easy to just do a check. Credit card used to give you these blank checks and you can write it to anything. But you can do it from a home equity line of credit or a personal line of credit. So you get this $12,000. You make a payment to your mortgage. That's the first step. You guys following me? Okay. So if you did this and nothing else, what this is telling you is using a $12,000 chunk, the total mortgage savings, it's already $39,398. Okay, you see this? This is the baseline. This is your new total principal or interest over the lifetime. And this is how much you save. You see, this is the baseline. You got your mortgage. So this is what I wanted to show. $39,000 on this one thing. Okay, but you're not out of this situation yet, correct? What you have to do now is every month you need to pay $1,100. You see that? You got to pay this much to the credit card or to your line of credit or whatever, where you borrow this money from. And so here's the interest. I'm computing using 18%, using the daily rate. Yep, I think the math is right. So you can see that at the end of this, when you pay this down, you're paying $1,200 in interest the first year. I believe I said $1,201 in interest. So I'm going to put it over here. $1,201 in interest cost. So the true cost is this minus, and that's how much you're saving the first year. Again, this is assuming you have extra cash flow to pay this down. So that means you just saved $38,000 on this loan. Now, just to show you real quick, normally what you want to do is you repeat this process next year. So the loan is paid off, you're going to repeat it, you do it again, and you'll see what happens. The loan gets shorter, you save time off, and then you just repeat and repeat. I'm not going to demonstrate the whole repeating process, but you can see how if you do it the second year, your total interest is now less. You just saved yourself $72,000, and then if you just multiply the math, if you do this again, the first year you paid $1,200. The second year you're going to pay another $1,200. So in total interest cost, that's $2,400. But you already saved yourself $72,000 on your mortgage. Hopefully you got that. So that's the savings. So does it work? How is this possible that you're borrowing money, paying 18% interest, and still come out ahead? So the reason why this works is because of the way loans are structured. There's a lot of front-loaded interest. As you go down the loan, the principal, more of your payment goes to principal and less towards interest. And this is the reason why in mortgages, it's so easy to see. But it does work with car loans and student loans. But the longer the loan, the better or the more you'll see a bigger effect of how velocity banking could work. And this one is the next scenario. Instead of chunking and doing velocity banking the way most people understand it, what if you did it the old way, the way your grandmother taught you, the way before credit cards and debt was so normal? What people will tell you is just pay an extra $1,000 a month, because that's what you're telling people to do. If you already have the cash flow, and we already said we did, this is a monthly cash flow, you already have an extra $1,000. Why even do this whole chunking process? So let's take a look at it. We're going to model it out. So let's make sure if we do this right, this total payment should be $12,000. You see that? It matches our first scenario. And look at the interest rate. It's going to be a little bit lower. And let's see what that would do. The saving is what? According to this, $38,284. And because you're not borrowing any money, so what is this telling you? Here's the two costs. Chunking and borrowing money minus the $1,200. Look at this. Look at the cost. The paying $1,000 extra without doing chunking will actually still come out ahead by nearly $100. You heard me right. This is real math. If you didn't do chunking and you just paid this from the surplus of your monthly cash flow or your budget or your spending plan, you would have got very similar results as chunking. So this is where the Dave Ramsey fans will say, it doesn't make sense to borrow money to pay, right? Borrow from Peter to pay Paul, because if you did nothing fancy, and this stuff been around for, again, I don't know how long, 50 years, 100 years, you just send an extra $1,000 and pay it to the principal. Okay, so that's one scenario. Now I want to do the second scenario. What if the interest rate was much lower than 18%? You see, because there was savings. So I'll show you what I mean using the model. If this was truly a 0% loan, there's zero interest. And what that means is, if you reduce this out, which one comes ahead? The chunking will come ahead by $1,000. Okay, so I hope you're following me there. I'll give you another visual so you can try to understand this. Suppose you are borrowing money at 8.99%. Your total interest payment is $592 a year. So if you plug in $592 in here, that's the cost. This is the benefit of chunking. It will save you $38,806 the first year versus doing the extra $1,000. So even with extra interest payments, that's what it will look like. But I'm not done yet. Let's model one more scenario. Let's put this number back to where it was. I think it was like that. The third scenario is this. Let's go back to our original condition, 18%. You notice that in order to service this debt, your monthly payments are really $1,100 a month and not $1,000. So in order to compare apples to apples, we got to come back in here and change this to 1,100, because that's truly what you're taking out from your future cash flow. And if you model it this way, you're going to notice that the savings is bigger. And what that means is what? I'm going to explain this real quickly. If you are doing chunking with $12,000, and if you can afford the 18% interest rate, which is an extra $1,200 for the first year, then why not do extra payments using the same amount that you would have been paying to a third party or to another bank? This concept of, if you had that ability, wouldn't it just make sense then for you to do this yourself? Because even if this interest rate is zero, the cost of borrowing is zero, the most you can save is $39,000. But if you borrow nothing and did it yourself, you see this, there is nothing in the math that suggests that you can even get to $41,000 savings. So this is why modeling is so important. I can show you that, let's put this back to the other number so you can see it. If you put this back to $12,000, this is the chunking. You see, you're only saving $39,000, $39,398. But if you can afford it, then in theory you should have been able to afford this, because you're not paying interest to any other bank. Plus, you're paying it towards what? Your only debt that you're trying to pay down quicker, which is your mortgage. So in this scenario, this is always the winner. But let's just assume you're not going to do it that way. Does chunking work? So in a normal loan, you got to go back to the baseline. And here's your baseline. A normal person with a 30-year loan will do this, pay this much interest. And if you watch my previous video, anybody who refinances into a longer term loan. So let's say you lived in your house. You've been doing your monthly payments for 5 years. You refinance your loan back into another 30-year mortgage because you're trying to save a little bit of cash flow. In that video, you will notice that in theory, you're not really, you're saving money from a cash flow point of view today. That video explains the concept of refinancing only works if you shorten the loan term or the length of it. So in this particular scenario, you should be convinced that if you did nothing, and if you have the extra surplus in cash, chunking could work because the math does make sense. A 18% interest rate still beats a 5% interest rate in this example. And after servicing this loan at 18%, you're losing this much in interest, it still saves you money because we computed it over here, and your true savings, if you minus that out, you're really saving, the first year, you're only saving $38,197. But if you did nothing, you're paying, you see, you're paying the full interest to the bank. So I use an 18% interest rate. But let's just talk about, suppose you were chunking and you got something less, and I'm using 15%. Total interest rate is 997. If you go back here, and maybe I did do it, but if you do 997 in here, you see this? That means chunking actually saved money against this concept over paying $1,000 extra out of the future cash flow. So that's saying chunking here will save money if you did versus saving $1,000, right? If you did that. The lower your cost of borrowing money in this example, and in this first example, the break-even point is anywhere around 17% or lower, and you will become a winner, where chunking will beat this. As I said, nothing ever beats this, the cost of servicing interest. But if you want to know this, between chunking and paying out of future cash flow, chunking would beat it if your cost of borrowing is under 17 or 18%. And I just showed you at 15%, you would actually come out ahead. And you see, it's not by much. It's like $117 difference. Okay, so with that being said, let me restore these numbers back. So that should convince you. If not, it's okay. We're going to work through a couple more examples using different numbers, but I'm going to move faster now. So if you didn't understand it, you need to rewind the video and watch it again. I'm just going to do it for different numbers with different prices of homes and different interest rate, but the concept is still the same. I'm going to do less explaining from this point on. So if you didn't understand it, you need to rewind and watch the video again. Let's do our second scenario. Let's do a scenario that most people can probably relate to. You borrow $250,000. We're going to use, instead of 5%, we're going to use a 4% interest rate on this one. So before we start, let's reset everything back. Let's reset to 0. Let's track the baseline of interest. Okay, that's the baseline. And in this scenario, this guy's not going to be chunking $12,000. I'm just going to assume you have less income, less free cash flow. So let's model that out. So I changed the number slightly, and you can see if your free cash flow is $5,500 a month, which means you have about $6,000 a year. I'm saying here's your suggested chunk, but in this example, we're going to use a $5,000 chunk. And if you borrow $5,000 at 18%, here's your daily rate, here's your total interest, here's your interest payments. All computed for you. You can see it. Nothing is smoke and mirrors. I always use Excel to model this out. You see, this is the most optimum. If you borrow at 0, it's $416. Okay? So let's just show you real quickly what this means. We'll go back to the Excel. So that's your baseline. You're going to chunk $5,000. And in the beginning, you see how much you're saving? So let's go here. You're saving $1,168. There's an interest cost. Let's use 18 as our baseline. It's $500. You see that? $580. So it's $580 is your cost. Let's just, I'm too lazy to type. We'll just do this. We'll hit, okay? So that's the first scenario. That's how much you're saving minus your debt. The interest of carrying the debt is $500. So this is what you save in a scenario like this. you're saving yourself $10,000 the first year you do it. Now, don't forget, you still got to pay this loan back. So this is what it looks like. You borrow $5,000 every month. You go forward. You're paying it from your free cash flow, right? Now, obviously, this is assuming you got a job still, but this is how it will work. You pay it down. When you get here, you borrow another $5,000, and you start the process all over. And then that would be down here. You paid it down. You put another chunk. Now you can see it. The first year you save, second year you save, right? It adds another $10,000 in the third year. So again, we're just going to model it a little bit quicker. So now that you see what happens there, I'm going to model it using the additional payment. Okay? So my goal is to let's use an assumption of exactly 5,000 divided by 12. And if you do this right, it should add up. It should add up to 5,000. So I know I'm missing one more. And there you go. You see that? It's pretty close. And if you want it even more exact, I needed to do, hang on one second, 67 cents. That's what I was looking at. You see? I was missing the 67 cents is what I was trying to do. So let's do 67 cents. Now, there you go. You get your 5,000. How much do you save? So in this particular case, this is the 0% interest rate model. You save $10,882, 0% interest because you're paying it out of your cash flow. Here's the total. So you see how close they are. This one saves you a little bit, assuming it's 0%. So at which point does chunking make sense? So it's a $200 difference, if I did the math right. Yeah. So I need to lower this by 200 and, so I need to get to 286. Okay, hang on, I'll show you that real quick. I'm trying to figure out the break-even point. $10.9. That's 428. So let's plug in. Did I say 428? Okay, I'm still off. So I'm off by another 142. So I need to get this lower. So I need to drop that by 142. Okay, so you see that? That's 350. Okay, at a 7.3% interest rate, here's your total interest. Then what I did is I plugged it in here. And so chunking will beat extra payments even in future cash flow at an interest rate using 7.3% or lower. So that's crazy, right? It still means chunking can win if you get a low percent of interest. It makes sense to pay it up front and then service your debt because in theory you're still saving money. Hopefully you guys agree with that. And let's jump back to the last scenario, back to the 18%. 18% means you're paying $458. You see that? $458.40. So that is the 458 is the. So if you're paying this is what you do if you did no chunking. You can afford the cost of chunking with the interest paying to somebody else, but you did it yourself. This is the most optimum solution. Again, nothing will ever beat this from a math point of view. That's just the way it works. You see that? But if you can afford the 458, why not just apply it yourself? Okay? So I'm not saying chunking doesn't work. We saw that it beats the other numbers, but if you can afford everything and if you can do it yourself, you may not need chunking. But if you did nothing, remember the whole premise is, can you really pay off your mortgage early? And the answer is yes, because in this example, you sort of see it again. Real quickly, I'm going to model one more example in case somebody wants to look for something that matches their scenario. We're going to use 3.5, and that's the baseline, 246,624. That's how much you pay in interest. Now in this scenario, let's assume your cash flow is a little bit different. We're not going to use $500. We'll assume that you have a little bit more cash flow. I'm going to use $750 as your cash flow, 18% interest rate. Here's the first scenario. Okay, so you're going to chunk 7,500. So let's write 7,500. And your savings in the first year is over here, 13,505. The cost of interest borrowing is $948. And if you just copy that down, there you go. Versus, let's get the other comparison. So chunking saves money. Don't ever get me wrong. Do you see that? If you paid it up front, you're saving money. Or if you did it the old-fashioned way, like your grandma used to tell you, just do it out of your future cash flow. And then let's do this. If we did it right, I didn't do this right. I did one extra. If you do it right, the numbers should match. You see that? So in 1 year's time, this one saves you 1,178. There you go. So here you see the scenario where chunking save you more, but when you minus the interest, this is a true saving versus if you paid the extra $625, you see that? It's over here. And the last one is really, if you can afford that, $687.60. $687.60. That is if you can afford the interest and you actually pay that instead of paying it to somebody else. This is the one that is really the benchmark, or the highest, the most saving, the most optimal. Okay? Now what I want to do is, at which interest rate does chunking beat doing the extra payments here? So I need to shave off $600 in interest or hit 327. So let me try to do that. I think I used 6.1%, 316 interest rate, plugged it in here. At 6.1% interest rate or lower, the chunking will still make sense even against somebody paying an extra $625 a month. There's so many different variables and factors to think about. There's no easy way to model this and have a right answer for every scenario. You see that the optimum interest rate where chunking makes sense varies depending on outstanding loans, where you're at in the loan, the interest rates. I mean, there's so many other things to think about. It is not easy to do this and have a one answer for every scenario. But I think what you guys should see is, can velocity banking work? And does it work for student loans and auto loans? And you see in the case of a mortgage, if you're early in your mortgage, and early means maybe the first 10 years out of a 30-year mortgage. That's early. If you're somewhere in there, you can see this concept of paying down a lump sum, even if you pay interest, can still save you money. This is the big question of, how can that be possible? If I'm borrowing money at 18% interest rate, even though I'm only carrying that debt for less than a year, when you first borrow the chunk, you're paying it down every month. It still beats a low interest rate. That is why this is really hard to understand. In this example, we use a 3.5% interest rate, and I'm borrowing at 18%. And so the math should say, dude, that don't work. How can you borrow money at 18% and still pay less than 3.5%? Because the 3.5 was calculated over a 30-year loan, or even a 15-year loan or 20-year mortgage. This concept of just because somebody is telling you, hey, if you got a 3% mortgage, oh, that's cheap. Servicing that debt is cheap, right? That's what we've been taught, is cheap. But if you're someone who want to speed up some of your long-term debt, that you thought was cheap and you have enough cash flow, then that's what you can do. This is why it could work. Hopefully you see that in servicing debt, it is possible to borrow money and pay down other debts. And it does make sense. So now there's even a harder question. Would you ever use velocity banking to then buy an investment that generate a positive return? The reason why I say it's harder is because there's risk involved. If you're going to borrow money to buy an investment that generates a positive return, the concept then is you have to make sure that the spread is wide enough and that your investment will go up or guaranteed to go up. I'm not a big fan of answering that. I'm not a big fan of using debt to buy another investment. I think in some cases it could make sense. In fact, I think even if you borrow from your life insurance to do something like that, using an infinite banking concept, it may make sense. But again, I'm always hesitant to answer because I don't want to be like one of these fools that miscalculate. You always want to say, hey, it all depends on what you're trying to do and what you're buying. So, am I against debt? I'm not always against it. There are ways to use debt better than the way you're using it now. But my preference is just be debt free. Because if you're debt free, it gives you a lot of options to do everything else. I'll give you an example that's not related to this example. But if you have some assets that generate a cash flow, well, then what do you do with that extra cash flow? Well, you can do whatever you want. So I own dividend paying stocks. And if you're making money every month on dividends, because I don't have a need for it, what do? I reinvest the dividends. But what if I use my dividends to fund something else? Fund your lifestyle. What if I join some type of boating membership? There's a lot of these boat clubs in Florida that can cost you $500-600 a month. What if I use dividend paying stock to fund all of that? What that would mean is I'm using one investment to pay off something that I like. Or you can use another investment to pay off another investment to build more assets that generate more dividends or some type of positive cash flow into your pocket. So I'm not a big fan of using debt to fund it unless you're talking about mortgages in a case where you're doing rental properties or things like that. But again, each scenario all depends, right? The math has to work. It has to work with the risk you're doing. There are many other ways for an asset to generate positive cash flow. And I'm not going to cover it here, but that's why I do options trading. My security that I hold, my stock, the ownership of the stock or the business that I own, makes money when the share goes up. I make money when the dividend gets paid. And when I do options on it, I make more money on it. So a single asset can do 2 or 3 things at the same time. And this is the reason why if you use your assets properly, you can maximize it. In the same way, back to velocity banking, if you use your debt properly, you can maximize it. By now, you should see this is all about maximizing whatever situation you're in. If you're in a debt situation, but you have cash flow to handle it and service your debt, there are ways to get out of it quicker. If you're in a positive cash flow and you have almost no debt, then you can see you have the most flexibility to do a lot of other things. So I'd like to bring this to a close. Let's try to land the plane. Does velocity banking work? Well, it does. Even if I'm borrowing money at 18% interest rate, which I think most of us can do cheaper. I used to borrow money at 3, 4, 5% through a home equity line of credit. Personal loans, some of us can still get it at 6%, 8%, 10%. Business loans are somewhere in there, right? It depends. But it's possible. I use in my model an 18% interest rate because a lot of us know that is so high that it makes no sense. But in the models, it worked. Now, it doesn't work if you don't pay down that credit card or your personal loan. If you take 10 years to pay down that one loan or that one chunk, it shows that you have another problem. You don't have the cash flow that you think you do, and that's an issue. This is not magic internet money. This is the math works if you understand what is in your budget, how much cash you have every month. So it is possible for you to pay off that mortgage quickly. 5 years, not likely for most people, but you can do it. 7 years, more likely. 9 years, 10 years, 11 years, much more doable for the average person. And pay down each debt, and if you don't increase your spending, this is why the debt snowball works. If you were servicing your debt at, let's say, non-mortgage related, let's just talk about 2 cars or maybe a student loan. If you were paying $1,000 in servicing your debt and some credit card bills, if you start paying off some of those debt and you kept on paying the same $1,000 to service your debt, you should, over time, have less and less debt. And if you keep that $1,000, at the end of this, you're going to have $1,000 to put down towards your mortgage. And so that's the concept of what Dave Ramsey teach with this debt snowball. Can it work? Absolutely, it does work. And it doesn't matter if you follow his approach or some other person's approach. This concept of if you can service your debt today, and if you don't add new debt, you should be able to get out. The question is, how long does it take to get out? See, most people don't want to get out, or they keep on spending. And that's why the credit cards stay as a revolving credit. That credit card debt never goes to zero because 20 years later, you're still paying it off. It's revolving credit. And so as your pay raises go up, you expand on your eating out, or you expand on the type of car you drive, right? Your expenses go up. And that's why most people don't get out of debt. So this is possible, but it requires people who are not going to have lifestyle creep. It requires you to understand your budget and where your money is going. This is not a magic formula where money is generated out of nowhere and you magically get out of debt. But I answered, it is possible for high credit card interest to be more beneficial than the 4% mortgage interest. Hopefully by modeling it out, you saw that it's not that chunking doesn't work. I wanted to make sure you guys understand that when you use this $12,000 chunk, you can't just use the $1,000 payment that most internet gurus use, because there's a cost to servicing that debt. And really, if you want to pay it off in 12 months and do this process all over, you saw in my modeling, it says you needed $1,100 per month to service that debt. And if you're willing to do that and you can afford to do that, why not just send $1,100 to your mortgage directly? There's some other stuff now that I wanted to bring up. What is your goal? Some people want no mortgage. Dave Ramsey fans in baby step 6, it's a paid off house with no mortgage. For some people, that's their goal. They want that, I don't ever want a mortgage. I want to feel like I own it, not the banks. I want to be able to get a job. Instead of making $100,000 a year, I want a job that pays $40,000 because I don't have a mortgage. And so your lifestyle and the cost of it is much cheaper when you get rid of that big payment. For other people, it's the reverse concept. Why do I want to be house rich and cash poor? In fact, some people don't even want home equity. They never want cash in their house. Some people view owning a home as, I'll get a house, I'll buy a house, but I'll act like a renter, which means I don't ever want the equity to build. They cash out of the equity and they use it for other stuff because they're trying to say, I don't really care. I understand that whether I own a house or rent, there's a cost of living somewhere. And that's some people's thinking. That's, again, whatever you want to do, that's your thinking. Some people want to be totally debt-free. And I don't have a problem with that either. I think if you're debt-free, it just generally means you have more money for investing. Or you have more money to buy assets that generate more cash flow. Other people want to just have a lot of debt in terms of mortgages or owning 5 or 6 or 8 homes because I'm going to rent them out and I'm still cash flow positive. And on my balance sheet, I will have value. Even if I owe $10 million in mortgages, my value of my homes are worth $14 million. And other people are paying off my mortgages. And I just want to run a business that carries a lot of debt. And I'm using other people's money. And if that's your philosophy, it works. As long as you understand your cash flow scenario, as long as you understand what you're doing. So I don't ever want to teach this concept of there's only one way to do this. You have to understand what is your preferred method. Not everybody has the same method. But the math doesn't lie and it works. You can get rich doing many different things, or you can go broke doing many different things. The math doesn't lie, doesn't judge you. It is what it is. Hopefully, in this episode of Exposed by Math, you see that velocity banking is better than doing nothing. That brings us to the end of this video. Velocity banking does work. Hopefully, you understood the math. If you didn't, watch the video over. But please, like and subscribe to my video. I would like this to be the video on the internet that explains everything of how velocity banking works, when it doesn't work, or if there's a better alternative. And we saw that. If you can do extra payments, it will be easier and it will work. And it will probably give you the best bang for your buck. With that being said, please like and subscribe. I'm going to make a lot more of these Exposed by Math. There's a lot more other topics that people want to know about. And I will cover those as I get to them. Let's do this together, guys. Let's share this video. Let me help you win with money. As always, have a profitable day.